Got it. And Dave, you mentioned market makers. Just in, we've done some diligence work around exchanges and looking at market structure from that perspective. One risk we've heard a lot of is there are a few number of crypto market makers, and some have potentially like outsized trading volumes on a given exchange. Do you see that in crypto? Do you think that's like not the case?
I think you have to understand there's always sleaziness in every market. People will manipulate if they can manipulate. That's just the reality. So now you have to ask yourself, like, what are markets doing about that manipulation? And so there's two aspects to your question. And I want to cover the volume aspect second, because there's some important things going on there. But the reality is most of the major exchanges these days are employing firms like Solidus Labs or Aventus to actually look for manipulation. And if you want to understand where you want to trade on exchanges, if you go check it out and the exchange isn't doing something like that, you may very well not want to trade there unless it is for something that you see as extremely profitable. So if you have an exchange that, as long as you trust that they're not going to go bankrupt in the next day and you can get your assets off the exchange, it might make sense to trade. So we have clients trading on quite a few exchanges, but very few of them actually trust or leave assets on the smaller ones. When you talk about shady exchanges, etc. But there are some large international exchanges. Binance is extremely large. FTX, not the US version, is extremely large. Frankly, OKX and Huobi are pretty large. Bybit for derivatives is pretty large and now moving into spot. KuCoin has a lot of exchange, a lot of liquidity on a lot of second tier names. And then when you get down toward the third tier names, there are exchanges like Gate.io that our clients trade on. I wouldn't say any of our clients trust any of those, but at the end of the day, they're making an independent decision to buy an asset. If they can get it at a good price, they'll do it, which is very, very different than market makers trading on those exchanges and being dependent upon the pricing and the ability to get their money off of those exchanges. Those are different. Now, the second part of your question was volume. And I think it's really important to understand that virtually every market maker makes it their business to generate enough volume on the exchanges they need to trade on to satisfy the volume tiers of that exchange, because they want to have as low cost as possible. And so exchanges, by having these volume tiers, incentivize people to churn volume. Let's not call it wash trading. Let's call it trying to not lose money. But if you have an algorithm that is designed to make half a basis point and you tune it and say, you know what, I'm going to let it trade flat, trade it so it doesn't make any money. Guess what? It's going to generate a lot more volume because there's a lot smaller hurdle rate. And so there's a lot of that kind of washy-like volume. It's not illegitimate, but it's incentivized. And so it's just worth understanding that.
Yep. Yeah, that's really helpful.
Yeah, I mean, I would add to that, when they move down to, 0 bips profit, a lot of the exchanges do fee rebates as well. So, they're allowed to provide really tight liquidity. So when the liquidity is good, it is really good. I think the thing about this space that a lot of people get surprised in when they come here is when the liquidity is pulled, it is really pulled, and then there's nothing. So I think that's one main difference.
Yeah, that's a really important point to magnify. In every asset that's electronic, in periods of stress, the percentage of liquidity that derives from market makers has a direct correlation to the amount of volatility that results in periods of stress. It gets magnified. So, for example, if you looked at the difference in not the absolute level of volatility, but the difference in volatility between even Google and Citigroup in equities, when a very volatile period happens, Citigroup's volatility increases more. Why? Because market makers dominate in Citigroup because of the small spread, whereas in Google, there's less market making. And when you take it to an extreme, which is crypto, that gets magnified. So there's a reason why crypto has gap volatility so often. It's because market makers, when the market gaps, all pull their spreads. And we see it at Coinroutes. So one of our unique, and I hate doing commercials in these things, but it's just the only way to explain the advantage. One of our unique advantages is our clients can trade on exchanges and with market makers. But they can also trade with market makers with knowledge of the order books of the exchanges. So what does this mean? Well, when the market gaps up or gaps down, market makers might widen their spreads in both directions by 20 to 30 basis points during that gap. At the same time, the exchanges are more or less where they were. They're just the price levels moved, but the books are thick enough that the bid-offer spreads don't gap. So if you have technology that's looking at that, oops, I should avoid market makers at this instant. And then when the spreads normalize, we'll go back to trading with them. That's a big difference between crypto and other market classes, because in other market classes, market makers are often, frankly, regulated or incented strongly not to deviate their spreads, except when it really, really matters. In crypto, it's every day, hours, multiple times a day.